Hey there, it's Justin Heminger with Apex Realty Group at Discover Fairbanks, and today we're going to be talking about the top 10 credit mistakes that you can avoid when you're trying to buy your first house. So let's get right into it. And we got Bethany Yoakum here with First Rate Financial. She's going to help us get through this because we talk with folks every day that are working on building their credit and trying to get through the pre-approval process, and they're hitting brick walls, and we just want to do everything that we can to help people get prepared for buying their first homes. So let's talk about some of these mistakes that we can avoid and get on the right foot and get on the right path to buying for our first home. So let's talk about some of these. Let's hit late payments first, because that's one that can hit your credit report kind of hard.
In terms of how your credit score is figured out and the way that the credit bureaus kind of look at everything, your payment history is 35% of your credit score. So this is going to have the biggest impact. If you miss your payments, it's going to have the biggest impact on your credit score. But also making your payments on time is going to have the best impact on your credit score, right? So if you make a promise that you're going to pay this much amount every single month, just keep your promises and do it.
Easy peasy.
Oh, it's easy.
I mean, it's as easy as, having enough money to be able to afford, your payments.
Yeah.
And sometimes that can be tricky.
Yeah.
But as far as making those payments, is it more beneficial to make the minimum payment than miss a payment?
Yeah, it is. It's definitely always make your payment. If you can only manage to make the minimum payment on a credit card, make the minimum payment on your credit card, and make sure that you, I always just set reminders on my phone every single month to recur, like pay your credit card. There's so many things in place that we can have to make sure that we're doing it. And then really, I don't know what else to say really about it, is just make sure that you make your payments on time, not late. And so if they're a little late, you might just accrue like a small fee. Mm-hmm. And then 30 days late is when they start to report to the credit bureaus.
Because all creditors have like a little bit of a grace period within their little payment system. If we're making our payments but not necessarily making it right on time but still hitting it within that grace period, is that going to be something that's going to still impact our credit?
No, your payment's still going to be made on time. You're just going to pay a fee, so it's going to cost you more money. I don't like to give away money that is not going to benefit me at all, so I'd rather make my payment on time and keep that $45 that was in a late payment fee. The other piece is the more recent your late payments are, the more impact it's going to have on your credit score. So there's a recency factor in there as well. So if you're trying to apply for a loan, but you know that you just missed 2 car payments, it's going to have a huge impact on your credit score.
I could see that would be a big one.
Yeah, and make sure if you're traveling up here, especially military, if you're traveling up here, make sure you're watching that. Like I said, just set reminders. So there's so much going on when you are traveling that you set reminders so that you don't have any missed payments. So that all of a sudden, when you're in the middle of a report or of a deal, and if we have to pull credit for some reason, we don't typically pull credit in the middle of a transaction, but every once in a while, there's a reason that we need to. It's always underwriter discretion. If your credit score drops significantly because you missed a payment, that could mean you no longer qualify for that home.
And that would be a pretty terrible way to lose your earnest money, for sure.
Yeah, we don't want that.
And if you've got 2% of a $300,000 home, you could be sitting at $6,000 in jeopardy. So
yeah, exactly.
Yeah, that's a lot of money to be risking, for sure.
Mm-hmm.
All right. Next on our list is high credit utilization. So essentially, tell us about this one.
Yeah. So when you get a credit card and they say, woohoo, you've been authorized for this card, your limit is $20,000. You're like, holy cow, I have $20,000 to spend. Like, you just go on this huge shopping spree, but don't do that. So just because you have a $20,000 limit doesn't mean that you need to spend $20,000. One of the things that is negatively that I see pretty much the most when somebody needs to increase their credit score, the quickest way to do it is to pay down your credit cards, not pay them off, not close them, but to just pay them down to at least 30% or lower of whatever your limit is. So keep your balance at least 30% or lower than what your credit limit is. What that does to the credit companies, the credit bureaus, is it shows them that you are they look at it as you can manage your money well, that you're not just out there spending frivolously. So it's good not to max out your credit cards.
And with this one, I wanted to be sure, are we also talking about kind of overloading yourself with way too many credit cards?
I mean, I think overloading yourself with way too many credit cards is, it's hard to manage all those, I think the likelihood of defaulting on one of those is a little more likely. So, just keeping it minimum. And one of the things about credit, I think it's 10% of your accounts is, of your credit score is the diversity of the credit report. So you want, sometimes not having a credit card actually harms you. So one of the ways to get credit and to increase it, if you just have like 1 or 2 installment loans and maybe a car, maybe getting a credit card, and that will help bump you up to that next level. Like if you have a 740, that's how you maybe could get to like that 780 credit score, that 800 credit score, and put you in that top tier bracket for interest rate pricing. So that's a good one to do too. But yeah, that amount of debt, the amount that you have, when I said use about 30% or less of your balance of your limit, 30% of your limit should be your balance. That is 30%. That's the next biggest factor of your credit score, is the balance that you have. So make your payments on time, don't max out your credit cards, and you're already, at 65% of what your credit score looks up. Those are the 2 hugest things that you can do.
It's like we're 2/3 of the way to fixing our credit by just touching with the first 2 items on our list here.
Mm-hmm. Yeah.
Make sure you listen to the rest, watch the rest of the video, because, the other 35% is also important. But,
it is important. We're not done.
You got the first 65.
Please no, I am not a credit counselor or anything like that. I just look at a lot of credit reports being a loan officer. So this is just what I see. But I am not a credit counselor by any means. So if you have more detailed questions, please reach out to somebody who does that. Just a little caveat.
Yeah. Prank caller. Not a doctor.
Not a doctor. Not at all. Applying for new credit too frequently. That also is 10% of your credit score. So the best scenario or way to talk about this is when you go apply, and the most inquiries that I see on somebody's credit report is when you go to purchase a car before moving to Alaska. And a lot of people do. We have snow, we have ice, it's winter here 8 months out of the year. So I get, if you're moving from Florida, you want to buy a big truck with 4-wheel drive and all this stuff for your family, makes sense. However, when you go to the car dealership, they're going to want to try and get the best deal for you, the lowest interest rate. So they're going to check your credit with all of these different lenders that they work with. And the most I've seen is like 15 to 20 different credit pools, and for one car, and that person's score tanked over 100 points.
Wow.
It was a lot. And so I always, in that situation, do the similar thing that you would do with you're doing with a home. You're getting pre-qualified for a home, get pre-qualified for a car. You can kind of ask around and see what kind of rates are going to be with car dealerships based off of what your credit score is. You should be monitoring and have an idea of what that is. There's enough credit monitoring programs out there. And you can do that. You can advocate for yourself. You don't have to just sit there and do exactly what the car dealership tells you to do. You can be in the driver's seat for that too. So just watch how much your credit is pulled. A mortgage pull, just to kind of piggyback off of that, some people don't want to get their credit pulled prior to knowing before they're going to write an offer, but there's a lot of risk involved in that. So by not having your credit pulled, you don't know how much you're going to be approved for. We don't have a snapshot of your financial picture to know what you can afford based off of your credit scores and your debt to income ratios and how much money you got in the bank and all the different things that factor into being approved for a mortgage loan. And typically a mortgage pool, depending on your scenario, there's not like an exact number for it. It's not like a mortgage pool is exactly 10 points, but it's about 10 points is what, because it is a hard inquiry. Anytime that you're looking to add debt to your financial picture and you have your credit check to see if you're eligible for that, that's a hard inquiry, and you're going to get a little bit of a hit on your credit report, which is why when you are going hit after hit after hit after hit multiple times in a very short amount of time, that's why the credit companies that's why your score tanks, to limit how much you are taking on in a short amount of time to protect you. they don't want you to take on too much all at one time, thinking I can afford all this, and then you've maybe not calculated properly, and then you get in over your head, and then you default on all of these new loans that you've taken, all of these new promises that you've made. And so that's the reason they do that.
A lot of people think that it's just a punitive thing, like, oh, I'm just being punished because I've got low credit. Well, this is actually a self-protection measure, to keep you from overextending yourself. And a lot of times it feels awful because you're like, well, I need this to survive, but at the same time, it may be survival, but it's a lot like drinking ocean water at the same time.
Yeah, that's an analogy. Yeah, exactly.
Thinking about moving to Fairbanks? Well, click on the link below for my free relocation guide where I talk about top schools, top neighborhoods, and so much more. Next up is ignoring credit report errors. So this one happens from time to time, and it seems like a lot of people will just like see their credit report and be like, well, this is just what I've got, so this is what I've got to work with. Is that you just have to take it?
I would say the majority of people don't even see their credit report. They've never seen it. It's this weird thing that's like out in the stratosphere that nobody has access to, and they don't have, a lot of people don't know what their credit scores are. Even if they know what their score is, they don't really know what's reporting. And so again, that's why I think getting your credit checked ahead of time, like there's never too early to get your credit checked. Yes, we might have to like check it again. But if there is something on your credit report that we have to remove or that's negatively impacting your credit, there's disputes maybe that need to be removed, things like that, then that could prevent you from buying a home for your family. We have time to get that taken care of, and we're not trying to frantically get it done, and you miss it on the home that you want to buy, and then you can't find the same home again. Like there's a lot of reasons why just making sure that you're financially set up to buy a home when you get here, or when you're ready and you find the right home if you are here already, that it's always better to plan more than to just react upward.
For sure. I mean, we get a lot of people that are, just as you were saying, on their way up here. They come up here and they're like, all right, let's go buy a house. Let's get pre-approved and let's do this. And they're like, because I need a place to stay right now. And they find out that, they've got issues on their credit report, and, they're not finding a place to stay because they can't buy a house.
Yeah.
But had we started working on these things, a few months prior, if we have the luxury of time, because that doesn't always exist, but if we had the luxury and we could use the time that we've got to plan these things out, we could work on fixing some of these things beforehand and come up and have everything all set up.
Yeah, it's amazing how many. I've done multiple loans for people, and every time their credit score is like 800. I mean, it's right there at the top tier. And then one time he didn't think there was going to be an option or be a problem. Sorry, he didn't think there was going to be a problem. And when we updated his credit report, it went down 100 points, and he didn't qualify because there was an error. There was a late payment that reported on one of his credit reports, and it tanked his score 100 points because it had just happened. That was that recency factor. And it was inaccurate. It was an error, but it took like 3 weeks to get it removed. So, and he had already written an offer, and he was already under contract. So it delayed the process, and there was a lot of emotions involved. So doing it prior, just because it hasn't happened to you doesn't mean it couldn't happen to you,
Absolutely.
Yeah.
And there can be a lot of money, a lot of heartache, a lot of emotion, a lot of stuff on the line.
Yeah, a lot of money on the line. Yeah. Also, you don't want to close accounts necessarily. Closing accounts can negatively impact your credit score. So the length of time that your trade lines have been open is 15% of your credit score. So it is important to not just not close accounts. So it's the age of their newest account. It's the age of your oldest account. And so they kind of take like an average age of your credit score. So if you have a lot of new credit, not only do you have credit inquiries, but they're all new things that are reporting. And so that can kind of pull your credit score down too. But having things on having trade lines on your credit report that have been open for 10 years and never closed them, and they've always been in good standing, is going to really kind of give your credit report a nice sturdy backbone to lean on.
Well, I think that's another one too, where a lot of people will think, well, I'm going to pay down my credit cards and then I'm going to close those accounts and get rid of them. But it sounds like what you're saying is that if I just pay them off and then just keep them at a low to zero balance, that just having an old and open, maybe huge not balance, but a huge credit limit.
Yeah.
Is that going to be more beneficial than closing that account?
Yeah, just keep it open. Use it from time to time. Go buy a pack of gum or something like that. But it's more beneficial to keep that open. Just, when you close, when you pay up, I don't know if you've noticed this, if you pay up a vehicle, sometimes you'll see your credit score just dip a little bit. It's not going to tank your score, but it's just going to dip a little bit for a short amount of time. There's time to recover. But yeah, it does dip for just that short amount of time.
Right on. That's good to know.
Yeah. Co-signing on loans, especially when we want to help like mom and dad or brother and sister or a good buddy, is great at the time. And you feel like you're, maybe they're in like a really hard financial situation. You want to help them out, but that can negatively impact you and your family down the road, because if you co-sign on a vehicle for your buddy and they quit making payments, it looks like you're not making payments. You are just as financially liable as a co-signer as you are as if you signed on your own. That's the co-signing means that it's your loan as well. So even though you're co-signing and helping somebody else, it doesn't mean that you're not liable and that credit collectors can't come after you also. So I have definitely seen some people say, yep, that was back in the day when I was helping a buddy and I know it's on my loan and I keep telling him he's got to pay his stuff, but he's struggling, he's not paying, but he can't get me off the loan because he doesn't qualify for it. So he's stuck with it, and he's stuck with the ramifications of his buddy's choices, life choices, So that's, and he's going to pay a higher interest rate because of it, because his credit score is a little bit lower because of somebody else's situation.
And that one can be tough because you could find out a really long time later, like way down the road, that your best friend stopped paying on their car a while ago, and that your credit's been tanking the entire time.
Yeah.
So.
And then you find out that's a hard one. That's a hard pill to swallow. Yeah.
Yeah. Especially if it's a close friend, family member, that can be tough.
Yeah, because not only is it impacting your credit score, but that payment is also included in your debt to income ratio, unless you can prove that the other party has been making payments, the most recent 12 months of payments on their own from their own bank account. So there is a little bit of way around it. Doesn't always work. Maybe they missed one payment in the past 12 months and then you can't use that anymore. And so if they have been making good payments, wonderful, but it's just a risk by doing that.
For sure.
Yeah. The next ticket on the list is using only one type of credit. We kind of touch base on that as diversifying your credit a little bit. Again, that's 10% of your credit score. So don't just, only have a car loan and some student loans. Adding that credit card to your credit report is going to help. As long as you make your payments on time and keep that balance low, then it's going to positively impact your credit.
Yeah, diversifying, having a credit card that you use. One of the things that a lot of folks do up here is get that Alaska Airlines Bank of America card. Use that for your expenses. Get then pay it off at the end of the month. That way you're getting a whole bunch of miles, getting Alaska Airlines miles, and then you're also getting the companion fare. There you go.
Fare, yeah.
You're getting the companion fare seat every year, so you're getting that extra, free ticket anywhere that you want to go.
Yeah.
So that's a great idea.
It's a good one to have.
Yeah. Talking about making minimum payments, making your payments on time. One great way to do that and make sure that you do that is to have a budget. So that's a way that you can avoid, tanking your credit scores by, not having a budget. So let's talk a little bit more about having a budget and what that takes.
Yeah, knowing what's coming in to your family, to your household, and what's going out is important for any sort of financial literacy and what's the word I want to use? Success, like financial success, right? It's important to have good credit because then more things are available to you. You're going to have better interest rates, so your payments are going to be a little bit lower than somebody who has bad credit. It's just you have more options when you have better credit. And so having a budget and budgeting appropriately allows you to make a better decision of how much actually to borrow. So you're not just borrowing too much and not even realizing that you've overextended yourself, and then you can't, and you're in a hole and you don't know how to get out. So just making sure that you have a good idea of what's coming into your household and what is coming out, and then also putting money aside for like an emergency fund, like things that just life happens, and so it always, even when you don't, it always happens, like something is going to come up. And so just having that set aside to relieve some anxiety, to know that you can still pay your other bills on time, that's important too.
I agree. And we had talked about this a little bit before, but one thing that some other, I don't want to name names, other lenders from out of state have been known to do is to just kind of pre-qualify some people, send them a max pre-qual letter saying, hey, you're pre-qualified up to $500,000. You're ready to go shop. And people are like, this is awesome. I'm brand new to Alaska. I can get up to a $500,000 house. And then they'll go out and buy or start shopping for $500,000 homes, thinking that, well, if a bank or a lending institution says that I'm good for it, then I must be able to afford this. And by not having a budget and not knowing, well, maybe I don't know what the monthly payment looks like at a $500,000 home at 7.5%. By not having a budget, you don't know what you can afford. So you could very well get yourself upside down on your home before you even close on it.
Yeah.
So even though you may qualify for it, you may not be able to afford your own home.
You need to know what that monthly payment is. You're not buying, when people are buying a home or when people are buying a car, they're not buying or agreeing. I mean, you are, but what you're really agreeing to is the monthly payment. Nobody wants to spend $70,000 on a vehicle. Nobody wants to spend $500,000 on a home, right? And nobody has $500,000 or $70,000 set aside. Very few people anyway have that much cash set aside. So what you're actually agreeing to is that monthly payment. Can you afford that monthly payment? So that's why it's important to understand what's actually coming in and what's going out. If you can't afford, if you're looking at $500,000 homes because the bank said you can, but when the payment comes in and it's $4,000 a month, you're like, wait, that's not what I thought that payment was going to be, because the online calculator didn't include taxes and homeowners insurance, and you didn't have an actual conversation with the human about that, and no one educated you on that. And then you've put earnest money, and then you've realized that you can't buy the home, and now you're losing earnest money. Like it trickles down. So it's important to have that conversation up front.
Absolutely.
Yeah.
Next on our list is ignoring debt collectors. A lot of people think, maybe if I just don't respond, if I don't mail anything back, if I don't answer the phone calls, if I never return a voicemail, that they're just going to go away. But it doesn't sound like that's necessarily the case.
That were the case. If I ignored my problems, that they would go away, but that's never the case. Don't ignore a problem until it gets so bad that you can't ignore it anymore. Sometimes you can get ahead, and there's you can work with companies to settle or come up with a payment plan that's appropriate for you, especially when it comes to like your home or your vehicle or something like that is essential for you, for your family, for shelter, and to get into it from your job. So sometimes you can just work with them. There's a lot of options out there. Don't ignore them. Start the conversation, and you usually can work with them and figure out a plan. Yeah.
I mean, 9 times out of 10, they are people too. And I mean, they've got a job, obviously, but their job is to collect. And if they can find a plan that ultimately ends up with them collecting the debt, but it may take a little while, they very well could agree to that. So having a conversation with somebody is a lot better than just ignoring it, hoping that it's going to go away. Yeah, because it doesn't. It's like
I hate to say it's like a cancer, but if you treat cancer up front, you're way more likely to survive. But if you keep ignoring the symptom and it gets worse and worse and worse, it gets way harder to treat.
Yeah, it just builds and spreads.
Yeah.
Let's talk a little bit about debt settlement, because I think that that one's a little bit ambiguous, and I think there's it gets thrown around a lot, and people think, oh, this one might be kind of an easy way out.
Are you referring to like bankruptcies?
Yeah, relying on the debt settlement.
So I'm not super, I'm not like a credit counselor. I'm not a financial advisor, but when it comes, and I'm not like a financial attorney either. So if you really get into a pickle, there's different forms of like bankruptcies that you can file. Some of them are, where you wipe the slate clean. Some are, where you come up with a repayment plan, it doesn't impact your credit. Just know if that's what is appropriate for you to reach your goals in the future, if you do file, there are specific waiting periods that you have to meet, depending on the type of bankruptcy, the type of loan, and it's always dated from the discharge date. So it's not from the date that you file bankruptcy, or it's the date that that bankruptcy is discharged. So just sometimes that can take a while too. But you're looking at anywhere between 2 to 5-6 years waiting period on those.
Yeah, and a lot of people live like this. I don't want to say a lot of people, because that sounds very judgy, and that's not what I meant. But like the idea, the Michael Scott, I declare bankruptcy.
Yeah.
It's just this get out of jail free card, and all right, I'm no longer bankrupt. Everything's good. I can go and I can buy a home next year, and that's just not the case. There is some pretty lengthy waiting periods that you have to go down if that should happen. Sometimes it can be a pretty good parachute, but it does come with some consequences.
Yeah, exactly. And it's time, really, I say time heals all wounds, but really, like I said, you can recover. It just takes time in a waiting period. It just depends on what you need to do and what situation is best for you. Again, I'm not an advisor on those things of what would be best, but if you think that's the only option that you have, then certainly go talk to an attorney.
Definitely.
Yeah.
Attorneys can definitely help get a lot of things unstuck. Thanks again, Bethany, for joining us today. You've helped us kind of avoid, hopefully, a lot of mistakes that could negatively impact our credit, and given us a lot of tips that we can use to positively impact our credit and get us in a situation that we can be much, much more prepared to buy a home when we get to town. Really appreciate your time. Thanks again.
Thank you.
And if you have any questions for Bethany, you can find her information down in the description below. You can always reach out to us at 907-885-0316, or you can reach out to us on our website, www.fbxhomesearch.com. Have a great day.